Good morning. Welcome back to the Retirement Report. I'm Hank Parrot, your host. Now, I've gotten into a lot of dry stuff here as far as trying to educate you a little bit on fixed index annuities. I have a brochure if you'd like. Now, this one, and I've got a number of them actually. I think I showed you the one on Allianz, which is one of the better companies out there. Athene is another. If you'd like to, looking ahead to retirement, talking about fixed index annuity, the particular one here, the BCA, the Wall Street Journal article about annuities may be safer than you think and why. And then this piece, which was really good too, it talks about annuities as far as cash power. So what they're talking about there, one of the trade-offs when it comes to annuities versus, say, stock and bond portfolio is a stock and bond portfolio is completely liquid, meaning I can take money out anytime I want, put money in. There are no, penalties or restrictions there. Now, when you get into annuities, though, you have penalties if you try to move all your money. Now, they will usually, most of them have some form of free withdrawal rate, 5%, 7%, and most have a 10% per year withdrawal rate. Again, you want to make sure of that to make sure you're matching up appropriately. But if you're looking at RMDs, for instance, 4%, when we talk about safe withdrawal rates in that 4% range, and let's say you get really creative and you add some defensive strategies and maybe we can boost that up to 5% withdrawal rate, you're still looking at some danger here when it comes to your money. So if you're only, that aside, actually, if you're looking at 5% as your safe withdrawal rate, and you wouldn't want to take, then you've got 10% available per year, then it's still going to fit with your needs. And if you got an IRA, for instance, it's in an annuity, and you're looking at required minimum distributions, that's only going to start at around 4% incrementally over I think it goes up to 5% over a 10-year period or something. So that's your required minimum distributions that once you're age 72, you have to start taking out of your traditional retirement accounts. This is where the annuity can be, again, that liquidity feature, or that liquidity concern. So if you've got, again, a stock bond portfolio, I can take it out, 100%, it's 100% liquid, whereas with the annuity, I can only take 10% a year. But if I think of what my withdrawal rates are going to be, that more than meets the need. Now, there could be some other exceptions, so we don't, don't want to paint with too broad a brush. It's, again, why it's so important to have your own individual plan done. In fact, this is one of the areas I probably should, offer up to you, 615-376-5325. That's our number. If you'd like to get a comprehensive financial plan done, it includes, maybe you've got some annuities and you want to have another look at them and you're saying, hey, could you, are these good? How can I best maximize them? And are these going to be the best ones to be in? And I can help you with that and how to max it. If it is a good one to hold on to, then show you how you can make certain elections that can help maximize the value of it. In addition to showing you if you've got one that's really underperforming or doesn't, maybe it's one of the older ones, maybe it has caps, we can look and see if there's a way through a 1035 exchange that we can get you into something better. All of this is part of the comprehensive financial plan. So if you call my office at 615-376-5325, we can, at no cost to you, I'll do a comprehensive plan. Now, if all you want is to talk about annuities, and in particular, if you've got some you want to, or maybe just want to start there, of course, I can help you with that. But if you'd like to get the comprehensive plan, again, no cost. However, you're going to, it's going to require some time on your part to put this plan together. It was an old study years ago that said people spend more time planning a 2-week vacation each year than they do for their 20 to 30 years they're going to spend in retirement. So good planning can really help you maximize your resources. So if you'd like to get this comprehensive plan, again, call my office, 615-376-5325. We'll get your information, send you out a checklist of things to bring to your appointment with me, and when you come in to see me, I'll also give you a free copy of my book, 7 Steps to Financial Freedom in Retirement. We'll get that up again for you later. So this is one of those, the misunderstood cash power of annuities. It's another article if you're interested in it. And it talks about other ways you can do annuitizations. You can do partial annuitizations. You can ladder or stagger out incomes, as we've been talking about. Free partial withdrawals, systematic withdrawals, Terminal illness, most companies waive penalties for that. Nursing home confinement, same thing. Long-term care, same thing. And then again, income riders that can also help you get more money out of your account safely. So there's a lot of ways these can be utilized in planning, right? One I mentioned earlier about replacing maybe some bonds in a portfolio with fixed index annuities to get more protection against downside and greater returns over time. There's a lot of ways it can be used as far as income planning, growth planning, legacy, where you can maximize legacy. Some of them have long-term care riders, so there's a lot to it. Let's look at the next one. This is Citibank's Grandmaster Index. So on this one, about Citibank, by the way, Citi provides a broad range of financial products and services, including consumer banking, securities brokerage, transaction services, and wealth management. Physical presence in 96 countries, local trading desks in 77 markets, and a custody network in 63. Facilitates approximately $4 trillion in financial flows daily. Good-sized company. Now we'll look at the next page, Citi's dynamic optimization process. Now theirs is a little different, as you can see. 4 asset classes: equities, government bonds, commodities, and corporate credits. Designed, and again, monthly, changing, forecast 1,000 future return scenarios of the next year by using recent returns and historical periods with the VIX. This is your volatility measure, is elevated. Test the various asset allocation scenarios of each asset class and observe how each decision impacts the risk-adjusted returns of it, right? See how complex these can be, but they're there. Most of the complexities are about giving you flexibility and better options as far as return and, well, the diversification. Like these could be blended together, more than one index, to get you what you want. So they optimize to identify the asset class weights that seeks to maximize risk-adjusted returns over the 12-month period. And you can see on that one, it's averaged about 6% over the last 20 years. And then if we look at the backcasting, we see, again, higher participation rates, and the average is, you know, even in the lowest period, I think it was around 5.5. So it shows a lot of promise. These are not guaranteed, though. This is one of the things to keep in mind. When we're looking at index annuities, the only guarantee is 0, okay, in a down year. So it means the worst I can get is 0. I'm not going to take the loss that I would in a portfolio. One of the things that comes with that is that let's go ahead and take a look at the next slide, Wisdom Tree. So Wisdom Tree, whoops, I'm sorry, one more. So the returns we can see are quite good with that. Wisdom Tree. Now this is Jeremy Siegel. He has got a PhD, Massachusetts, MIT, Russell E. Palmer Professor of Finance at the Wharton School, and Senior Advisor to Wisdom Tree Management, Asset Management. So Wisdom Tree is another fund family with ETFs in that. And he's created this one in the funnel here, as you can see, this starting with the S&P, each quarter the 500 largest publicly traded U.S. companies are evaluated for operating earnings and, again, value. That's then narrowed down. The valuations are then used to identify the 4 most undervalued U.S. market sectors out of 10. The 4 value market sectors are equally weighted and rebalanced monthly to provide each an equal opportunity to contribute to returns. So again, we're using sectors. They're only counting 10 rather than 11, but the concept's valid. Excuse me. And then we have the strategic way to protect against declines. And this has to do, again, with that stock bond allocation and how, based on volatility, you might be heavier in equities and lighter in bonds. The Wisdom Tree, about 5.3. And then if we look again at the backcasted performance, based on the Wisdom Tree, the participation rates, with the fee, you get 160% participation. Without the fee, only 90%. And it shows then that even with the fee, you can end up with a better return. Again, we would walk that through for you and help you see if that's the one for you. One of the things when it comes to index annuities and annuities in general, again, I want to stress it's not for everybody. I'm not trying to, sell you a particular product. I'm trying to show you some features and benefits in general that you want to look for to help you get the best the best deal, if you will, for you. We're going to get into that a little bit more and how annuities can work and how in some situations maybe they're not the best idea. First a break. Join us here. We'll be right back on the Retirement Report.